Yeah, you're live.
Hello everyone, my name is Ritika Prasad and I welcome all of you to the fourth edition of Growth Sutra session Shape, Sharpen and Shift Go-to-Market for Recession. Before we start our session, I request all the participants as you join in the session, please introduce yourself by mentioning your name and your location in the comment section. Also, if any participant have any queries, please put that in the chat window. We will try to answer that soon. Okay, so the host for today's virtual session is Mr. Vishendra Verma, who is also the founder and CEO of Growth Sutra. I'll pass on the mic to him so that we can begin with the session.
Thank you, Ritika. And good morning, good afternoon, good evening to all the audience on the LinkedIn Live. We have Dennis, who is the founder of Romance Numbers and who is also a senior advisor to Growth Sutra. So as per our ritual, we are going to have 5 minutes of pre-session before we are going to start with the session. In this pre-session, we are going to address some of the questions which we have received from the audience through the email and through their direct messages to us. Uh, hi, Dennis.
Yeah, good evening, good morning, good afternoon to everybody. And hello, Vish. Hi, Radhika. Thank you very much for today.
All right. So the first question that has come is, how do Wall Street concepts influence this approach, and what role do they play in shaping it? So I think this is related to the theme of the event, which is shape, sharpen, and shift, go to market for recession. And the question is related to Wall Street concepts, how that can influence this go to market approach, and what role do they play in shaping it?
I thought that question was very prescient. Whoever asked it, I thought that was a very intriguing question that they had posted to us. Vish, as you're aware, and now everybody else, will be in our April 20th, our next webinar, we're going to be discussing specifically how we qualify leads, and the discussion will be around whether it's mostly magic or mostly science. Okay, so that'll be our next one, and this one goes to the heart of the. So, for instance, if any of our audience was going out on an auto trip, and uh, we're going into an area that they weren't familiar with, they probably wouldn't do it without a map, or at least a digital map, right? They probably wouldn't do that. And even if they went walking in the woods, they take a walk in the woods, they'd like to have a map of the trail that they're going on so they don't get lost. Same idea here, that there's maps out there that can be used to help people figure out what their go-to-market strategy would be. And at the highest level, one example would be nobody should really be pursuing an account, if you will, without knowing the financials of that account, and this is the big one, and the financials of that account's three biggest competitors. Those will be very helpful in being able to go out into the marketplace using the baseline of Wall Street concepts in order to have a more relevant discussion and impact on the audience that our sales and marketing teams are in pursuit of. Back to you, Vish.
Yeah. So I think that's a very interesting answer and quite relevant. So second question is, what are some key metrics to measure the success of a shape, sharpen, and shift GTM strategy during a recession? So how do you
Um,
measure?
so my guidance here would be not be capturing leads at the top of the funnel. I'm not saying abdicate that activity, but that the subdivision of that capture start kicking in right away. You know, and here's what I mean by that. So imagine there were, I don't know, 200 marketing qualified leads coming into the funnel and have become marketing qualified leads in one way or another. Um, my recommendation is to go find within that haystack 10, 10 accounts where 70% of the activity would be given to. And how would we find the 10 accounts? Well, first off, we're going to be discussing this today as a recession is coming. During a recession, some sectors of the market do real well and others do real poorly. Knowing which sectors do real well and real poorly can really inform how to modify the the GTM, the go to marketing uh, strategy for our sales and marketing teams. So let's assume we now know that these sectors do really well and those sectors don't do really well. So we might have automatically reduced the 200 MQLs down to a much more manageable number. And then the second activity might be to really figure out which senior, not even senior, executive management teams really are on the job. They really, really, really know what they're doing. There is no such line item in the financial statements of public companies that says our management really knows what they're doing. But there is data in the financial statements when our audience knows what those are. They can immediately understand that these people really know what they're doing. So we might end up with 10 out of the 200. These segments will do real well, and these executive management teams are phenomenal at managing their businesses. I would spend 75% or so of my time working on those 10 accounts, and the other 25% of my time working on the other 190 accounts, if you will. I'm making these numbers up, but the idea.
Yeah. I think that the strategy is important, especially to measure the success of such programs, and without data crunching, without keeping eye on the numbers, it becomes very difficult. All right, so let's now start our session. We are already 9:30 here. I would request the participants to share their names and location when they join this session. I see Vijay, who is joined from Hyderabad, and it seems the other participants are also joining in. I also see Tyler Perry, who is joined, and I am assuming others are also joining, but I would request them to add their location and name in the chat window. All right. So the topic of the session today is shape, sharpen, and shift. Go to market for this session. Now you all agree that the business cycle goes through 6 phases, which is expansion, peak, recession, depression, trough, and recovery. And recession is the most undesirable phase of a business cycle, as it can break or make a business. So in fact, if when you hear words like job cuts, liquidity crunch, and lower customer spending, immediately come to mind when the term recession is mentioned. Many big businesses have gone bankrupt during the past recession cycles. So if you name them, like Enron, Chrysler, General Motors, Lehman Brothers, and recently Silicon Valley Bank, Signature Bank. Um, while these companies, these are large firms who have kind of um, badly impacted during recession, but there are many companies who have found opportunities even during the recession phase. So, for instance, Microsoft, it was during these difficult times that college dropouts, Bill Gates and Paul Allen, developed the concept of easy to use computing for homes and offices. Apple pivoted its business during the dot com crash of the early 2000s and the wake of 9/11. Airbnb, that was born out of recession. When in 2007, when Brian Chesky and Joy Gaviba thought of renting out an air mattress in their San Francisco living room, they didn't know that December is when the Great Recession is going to start, and that will offer them an opportunity. So Airbnb changed the short-term housing market for those who couldn't afford hotels. So they grew rapidly after receiving top-tier funding in 2009. Um, the other example is Mailchimp. The Mailchimp initial target audience were all primarily large corporates, and they were willing to pay annual retainer fee. However, when the Great Recession hit, Mailchimp had to change its approach to businesses, and it launched its freemium model in 2009. And its user base actually increased from 85,000 to 450,000 in just 1 year. So it depends on us how we, as founders, and leaders, and sales and marketing, respond to such business cycles like recession. And today in our session, we are going to talk about how we can shape, sharpen, and shift go to market for recession. And I have my dear friend Dennis, who has been part of these Growth Sutra in 30 minutes sessions, which are very short and punchy, um, uh, virtual forums, which we have been organizing for last couple of months. Um, before we start, let me also talk about what are the various um, uh, topics which we are going to be covering. So we would talk about macros that indicate recession. We'll also refer to signals from the data of the public listed companies, implications on your GTM with the recession looming. Then is going to be followed up by certain recommendations. And yes, towards the end, we will also talk about SMEs performance during the recession, and how SMEs can repurpose their business model for economic cycle like recession. So without taking much of time, I'll now invite Dennis to take over from here and take us through his insights. Dennis, over to you.
Thank you, Vish, very much. And thank you for the audience joining us today. I know everyone's busy, so let's get right into it. What's our first slide, Ritika? Okay, now I'm going to show, and Vish is going to show you some classic, what I would call egghead slides, right? Egghead. All that stuff that we've seen, but they're still very important. So we'll show you egghead slides about the recession. But right now, we're just showing you an extremely practical example of what inflation means. In July, I bought those 5 tubes of toothpaste for $14. And in March, I bought the exact same 5 tubes of toothpaste for $19. That means that's a 33% increase in one item in 7 months, which comes out to about 4.7% every month. So we hardly need an economist to make this point on the B2C space. But by extension, this is exactly what's going on the B2B side, as I'm sure you all know, because you're trying to get out there and sell and market stuff. I mean, it's a breathtaking increase. I don't know about you, but my salary hasn't kept. I didn't increase my salary by 33% since last July. And yet the stuff I'm buying has gone up. Something as trivial as toothpaste. Anyhow, I thought that would be a good way to get started. All right, Ritika or Vish, let's look at the next one.
Yeah, I'll move to the next slide. Yeah.
So here's one of the egghead slides, if you will. So this is the conference board, which tracks about 15 leading economic indicators. And the pessimism is pretty obvious here. They're saying that the economic indicators are showing no signs at all of recovering. And the translation for that, we're going to have a recession. That's what that means. So on a year-on-year basis, the leading economic indicators is down 6.6%, which is worse than the 6.03 in January. But it's still close to the biggest year-on-year drop since Lehman Brothers went out of business in 2008. So what we're looking at on this chart is the high points. Whenever you see a real big high point, that is the pessimism in the leading economic indicator. And so you could see where we ended up. The zero line and where the red circle is right now. You saw what happened with Lehman Brothers, how low it went. And then on COVID, well, we're approaching that same level of pessimism right now. Okay, so that's what's going on, because I know some people are denying that a recession is coming, and I'm not sure why they're denying it. Okay, let's look at the next one. I think we have some questions for our audiences, right?
Yeah. Yeah. So we have a question, which is what adjustments are being made by order of preference. What is your own company doing, or you have observed the companies you are calling upon are doing that suggests a recession is coming? So we have six options which have been provided. One is HR. The A is HR optimization, which is referring to downsizing, layoffs, compensation downgrades or bonus cuts, elimination, hiring on hold. Then B option is on investments break, which is marketing and sales budget cutting, pushing off spending. C is slowing product solution development, R&D innovation. D is focusing more on customer, more bang for the buck, price change. E is monitor, analyze, and feed shifting priorities to repurpose GTM. F is looking to pivot business model, which is making it more purpose driven, changes in market presence, or adopting collaboration. So depending on which one you prefer, you could share A, B, C, D, E, F. One or multiple options in the chat window, so that we can understand which one you prefer as part of this question. So I believe there's some lag before we can start um, getting the response. Uh, so Dennis, what is your, what would you inference from this, question, and how would you suggest the normally are the adjustment during recessions?
Well, my hints earlier about tightening the focus, qualifying the activity better, and tightening the focus is definitely going to be front and center now. So again, 200 leads, but find 10 that really, 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 really ought to be getting your attention. That's just an example. So there's no question that the market is laying people off left and right. And that budgeting cuts, which were under constraint even before all of this, are under further constraint. So it's going to make getting financials or getting budgets to be able to pursue various activities. We've seen problematic for sure. We've seen a flood of in-person events when COVID was coming down, and everybody wanted, Cybos and the American Banker. I mean, there's a lot of events that are now fighting for in-person events, but I'm afraid that those opportunities are going to start washing out to sea as our audience experiences budget cuts. So it's the way that they can change their go-to-market that will, obviously have the biggest impact. And if they go to market using the traditional methods, they're probably going to be disappointed, because most of the marketplace right now is tone deaf. Tone deaf to have people pursue them for quality opportunities. So it's a complex and complicated problem. And we're here to help try and rationalize what might be the best way to going about it.
Yeah. So in fact, we have started getting responses from the audience as well. And of course, it's a mixed responses. But I agree to your point. And in fact, this is very complex, and every organization have their own way of making these adjustments, depending on how prepared they are for recession or such economic cycle. Okay, I'll move to the next slide.
Please. Okay, so I put this together. I will mention that I plagiarized the right side. Those 4 covers on Forbes, When I saw this earlier in the week, I mean, I literally dropped my phone. I said, how can these experts be so wrong? Okay, so I took those four covers, which are supposed to be self-explanatory, but they're really not. It's just, you got to explain them. So Elizabeth Holmes in the number one spot was absolutely the darling of Silicon Valley. She was the poster child. Well, anybody not knowing this, she's in jail for fraud.
Yeah.
Fraud, not, parking meters. Fraud. She fraudulently spoke to her investors over and over and over again. And the experts were dazzled. Oh my, she's in jail. We're all out, right? We're all doing our jobs. Okay. What can I say about Sam Brinkman-Fried? Absolutely the hero of the tech space, the hero that he's supposed to be in jail, but he's actually out on a $250 million bond, staying at his parents' house for fraud. Fraud. How can somebody of Forbes' stature be making these statements so often? Now, if that isn't embarrassing enough, number three, Forbes claims Silicon Valley Bank was one of the best banks to invest in 2023. Silicon Valley Bank, for anyone who isn't aware, is out of business. They're gone. And who did they service? Silicon Valley. And if you want to add my own personal gripe about this, the chief risk officer at Silicon Valley Bank is also the person who was the head of the ESG movement. So it wasn't like the bank had somebody pursuing ESG and someone else pursuing risk. This is the same person, and they still went out of business. I don't know how much more damning that could be. ESG is very trendy until you get punched, until you experience a recession, and what we all start to realize, G dwarfs the importance of E&S. Okay. Then the fourth one is Adam Newman's WeWork company. Stock dropped from 744 down to 92 cents. And this is the cover of Forbes. The message here is do your homework. Don't rely on anybody. Don't rely on me. Don't rely on Vish. Do your homework. Read everything, but do your homework. Because if you're going to rely on the experts, woe be to you, because the experts really get this stuff. Okay, that's the message on that slide, Vish.
All right. So I think we are going to go to survey 2, which is how can you and your firm adjust? And as much as even CNBC's Jim Cramer urged viewers to buy Silicon Valley Bank stock as recently as Feb 2023, in what ways might you approach your GTM for public listed companies like SVB if such experts are so fallible? What governance, pick top 3 from below, are you personally using today to inform your business decisions? So we have 5 options here. A, establish internal personnel as a center of excellence for research. B, contract and highly specialized individuals or small firms for breakthroughs. C, establish a common digital library, free and subscriptions, with recommended playlists. D, perfect the Marcom stack, campaign plus feedback and rinse and repeat. E, establish data-driven and very specific goals matrix and learn from the aberrations. So audience can share their options in the chat window. Out of A, B, C, D, E, you can pick one and share with us. Okay, so while we are waiting for the responses, Dennis, what is your recommended approach here?
Well, certainly, I think there are no wrong answers, clearly, and some may be more applicable to some people on the phone, some people on the webinar than others. All of the answers are right, but as Vish asked us to do is to prioritize. Where would you prioritize? And I'm going to admit this is fairly self-serving, but I'm going to say it anyway, because in my heart, I think this is true. And that's why I'm doing these webinars with Vish. I think item B ought to be like front and center for your companies, especially if they're laying off. Get involved with highly specialized individuals or smaller firms to develop the breakthroughs that you need. I admit it's self-serving for me to say that, but I believe in my heart that is a right answer for a lot more companies than who are thinking about it doing so. Because if they're saying, I'm laying people off, and Dennis is suggesting that I hire in some contractors, yeah. Convert your fixed costs to variable costs, establish really short timelines, put them on a really short leash, and manage the heck out of their expertise. There's a lot of expertise walking around on sale today, just like there is public companies. That's the quick answer, Vish.
Okay. So let's move to the next slide, which is on inverted yield curve. And yeah, go ahead, Dennis.
So the inverted yield curve, probably everybody on the phone or on the webinar knows what it is, but it bears at least mentioning. So now every time you get to a high point, which is the inverse of the leading economic indicators from earlier, from the conference board, this is if the number gets real up high on the chart, you're in trouble. Now, in and of itself, we're in trouble, okay? But now you realize every yield curve inversion since World War II, everyone has led to a recession. Not some of them, everyone. And when that chart goes high, and high means above the red line. The red line is the separation between neutral interest rates for long and short-term bonds. If short-term bonds start paying higher interest rates than long-term bonds, that is not the way the marketplace is supposed to work. Now that very, I don't know, egghead kind of an answer is difficult for people to hear and think about. Oh, it hurts when I think about this. What it really means is the marketplace is extremely pessimistic about the future. How do we know? Because the demand for short-term bonds is so high, and it's only high because the investors think buying long-term bonds is dumb because, okay, and that's demand. All right, so every single time this has happened, we've had a recession. So you don't need to spend any time convincing your boss that we're having a recession. We're going to have one if we're not already in one, and I submit we are. The time is, how do you act? How do you perfect your go-to-market in order to deal with this coming recession?
Yeah. I'll move to the next slide.
Okay, so during a recession, there's no question. Sales goes down, inventories rise, access to credit decreases. And okay, fine. That's pretty egghead stuff, Dennis. I don't care. What I do care about is your next 2 points, Dennis. When you're in a recession, you know what the companies that you're calling on are going to do well? Consumer staples, healthcare, energy, communication services, and utilities. That's just a fact. That's just a fact. It's not my opinion. It's a fact. When there's a put it this way, in a recession, you know who's not going out of business? Walmart, dollar store. They're not going out of business. They're gonna flourish. And the companies that are going to really underperform and hurt. Oh, look, financials. Let me think. How are financials doing today? Oh, yeah. Banks in Switzerland and London and California and New York are all going out of business. Maybe there is a recession coming. Okay, information technology, industrials, and materials. So knowing which sectors will do well and poorly, that doesn't mean you have to abandon the people. You might want to go after the likes of Silicon Valley Bank's competitors with risk solutions, right? That doesn't mean you shouldn't try to sell the financials. Just be aware they're not going to have a lot of money to spend because they're going to really suffer during a recession. And maybe you'd be better off by going chasing Walmarts and consumer staples. That's the broad strokes.
Yeah, the initial qualification can be on the basis of these facts, historically which organizations have performed. So yeah, the first point of qualification can be that. All right, moving to the next slide, and that's survey how to adjust your GTM, and of course, it seems the bullet points have got jumbled up a little bit, but there are six options which have been provided to these two different industry groups, which Dennis talked about, and these options are: A is revenue. So when you're pitching to a CEO regarding regarding a prospect or regarding which industry you are in, what are the how what GTM approaches which you would pick? So one is revenue. Option A is revenue enhancing offerings. B is cost cutting solutions. C is simplifying the operations. D is innovation. E is re-engineering, and F other. In case if you are familiar with any of the other GTM which you would like to recommend here, you can share your insights here in the chat window. So if you can pick the options and share in the chat window, then we would we would accordingly take it forward from here. But I think Dennis, since there's always a lag in this
Yeah.
streaming,
So,
so
so,
maybe you can take over and you can yeah, share your
so
inputs.
my intent here is to just get the audience thinking about how would they approach a information technology or an industrial or materials company given a recession versus how would they approach a consumer staple, et cetera. Just imagine yourself to be the CEO of one of these two types of companies, and what arguments would you make? And if you
Mhm.
come to the conclusion that you're going to make, okay, your company represents 15 different value propositions. If you're going to go out and push those 15 value propositions at the first group the same way you're going to push them at the second group, I don't think I'm probably communicating very well, right? Your go-to-market ought to be getting modified and shaped and adjusted in order to deal with these different kinds of companies and what they're going through. It may be an oversimplification, but there's a lot of merit to just thinking about what you would do differently depending on what kind of company it is. All right, Vish, let's keep going. All right, this slide is a picture of the same one that I just talked about. You can see the recession on the right, and you can see real estate, high information tech, industrials. So it's a restatement. It's just a pictogram. And I think, Vish, we're making our slides available. If people want to write in to you or me and ask for the slides, we'll make them available
Yeah.
to you. But this is just a picture of the same information. It's a nice shorthand chart so that someday when the recession ends, you'll come back and you'll pull the chart out again and go, hey, Dennis, what's the early stage winners? And there they are. There's the early stage winners for you. Okay. So let's go next. Okay. So if you are seeking average results, then follow the leader. If you want better than average results, the onus is on you. Take webinars like this, incorporate the learnings, get in somebody who's really qualified to help your teams. You're going to have to find where the sunshine is. Okay. And don't be reading Forbes magazine cover stories. You need to analyze the companies you're going after. Okay. Vish, the next one's important. This is, again, a pictogram that I just think is remarkable. Silicon Valley Bank went out of business. And you know what happened? The largest transfer of money in the ETF industry happened in recorded history. You know how long ETFs have been around? And all of the money left one ETF. Guess which one it was? It was the ESG ETF. The ESG ETF, invest in companies that are really doing ESG. Oh, goody, that's trendy. Oh, goody, goody, goody. Silicon Valley Bank went out. Silicon Valley Bank was getting known for being the ESG poster child on the whole planet. They went out of business and everybody went, like Mike Tyson said, everybody has a plan until they get punched in the mouth. Everybody realized they just got punched in the mouth on ESG. So everybody, every institutional investor took their money out of ESG and put it into quality, an ETF, a quality ETF. So what happened? E is not so important. S is not so important. Governance is important. The largest outflow in the ETF industry ever happened with the money coming out of the ESG ETF. What does that tell you? Oh yeah, let's chase the next trendy thing. No. Do your homework. All right, Vish, what's the story on that slide. Okay,
All
one
right.
more.
Yeah,
Okay,
I think that's an interesting one.
this is the inside the tent secret. Okay, this innocent looking slide. Oh, you know what you get with this? You only get the green boxes. I put the white boxes at the bottom. Okay. Okay. If you had all day to look at this, you would come to the right conclusion. But you don't have all day, nor So let's look at this. First test question. How many stocks are in the Dow Jones? Okay. Everybody probably knows 30. How many stocks, this is easy, are in the S&P 500? 500, Dennis? Yes, there's 500 stocks in the S&P 500. Okay, the Dow 30 is the biggest. The S&P 500 is 500 of the next biggest, including the other 30. And then what's in the NASDAQ? Well, the NASDAQ has like 2,500 stocks in it, but they're market weighted. So the 10 largest stocks in the NASDAQ make up 47% of the performance. What does that mean, Dennis? That means the other 1,900 stocks in the NASDAQ don't matter. That's what it means. Okay. All right. So that's all true. And then the Russell 2000. Hey, Dennis, how many stocks are in the Russell 2000? Oh, yeah, 2000. Okay. So during Feb to mid-March, the Dow went up 1.11%. The S&P went up 0.73. The NASDAQ actually went down 0.07. And the Russell 2000 went up 1.61%. Now, that may not seem like much to you, but 1.61% is already 100% greater than what the S&P did. And forget about how much greater it is than the NASDAQ. What does all this mean, Dennis? This means if you have your druthers and you're going to be going to market chasing companies, you should be chasing smaller ones during a recession. That's what the Russell 2000 is. They represent that doesn't mean small. It just means smaller ones. They're the ones that are going to recover the fastest. This is like every equity analyst in the world knows this, but almost no sales or marketing people at tech firms know this. It's not a secret. It's just we haven't been trained, which is why I'm in business, to help people find out where these secrets are buried. That's it, Vish, for that.
All right. So we're coming to the potential approaches to match a type of companies in pursuit. And there are some recommendations which you have shared.
Yeah. So we're at the end. I mean, these are all top of mind things that are going on in the marketplace. This list could be twice as long probably, but I'm providing this to hopefully to our audience, if they want the slides, to just write into us. All right, Vish, back to you.
Yeah. So, there are a couple of indicative messaging here in terms of what could be potential approaches. But what I also intend to cover as part of this session is how the SME organizations are being impacted during recession. And as you know, Dennis already talked about the charts and the numbers, how they reflect that SMEs are actually getting different treatment as the large caps. So if you look at the recent study which has been done by Schroders recently, and they have shared some numbers in terms of historical performance of global large and small caps based on the economic cycle. So in fact, they did a assessment on the basis of data which is span across 40 years. That includes numerous recessions in the United States, Europe, and Asia. And if you look at the performance of small caps, that's almost double to that of large caps. So annualized net total returns in US dollars in percentage terms for small caps is 9.9%, and that's especially in the recession and recovery phase. While large caps in the same phase have delivered 4.9. So that again resonates with what Dennis shared in his previous slides. But what is also important is why SMEs are giving higher returns as compared to large caps. And of course, that lies in their DNA, in their genesis. And if you look at how buyers sees SMEs during recession, one is of course they are lean and agile, so they can adapt very quickly, very fast. And SMEs should continue to be efficient in order to meet that expectations of the buyers. They are focused on certain segments. They are nichely focused on certain areas, certain industries, certain customer segments. What is important for SMEs, if they can develop a clarity in their value proposition that can actually take them, you know, um, uh, make their offerings more clear to their target audience. Third point is cost effective as compared to larger peers. So, when buyers look at the products and services that has been offered by SMEs, they certainly look at the pricing, and pricing is certainly lesser than their larger peers. But what is also important for SMEs is to focus on offering more value. So during recession, I think what also matters is the value which has been delivered to the customer, and that's where the SMEs can also focus on. The fourth point is stick to lower overheads, because this is a time and it's very important to maintain liquidity. So you need to stick to lower overheads, so that whatever cost savings you can pass it on to your customers, or your stakeholders, your employees. Lastly, and which is very important aspect, is the entrepreneurial spirit. So they have the passion there to deliver certain specific solution. SMEs have the intent to meet the expectations of the buyers. But what is also important as part of this entrepreneurial spirit is 80% of the effort which has been put together by founders and entrepreneurs is marketing. And it's very important that you strengthen thought leadership. You leverage digital marketing is the most cost effective channel which can be leveraged in terms of reaching out to your target audience, and in a more consistent and in a manner, so that they can that can resonate with their needs, their requirements. So these are the 5 pointers which I recommend, especially SME should focus on during recession. Now we are closer to the end of the session. If there are any questions, we'll be happy to address. I think, Ritika, we have received few questions, right? So you want to just share those questions?
Yeah, we they receive some of the questions through emails. So one of them is, how can SME companies who are pressed with liquidity during recession maintain a strong brand image and customer loyalty while implementing cost-cutting measures during a recession?
Right. So, as I shared in my previous slide, so there are a couple of measures which SME companies, small and mid-sized enterprises can adopt. But in terms of maintaining a strong brand image, it's very important they turn more customer centric. They leverage thought leadership, because that's how you can share your insights, your expertise with your target audience. You leverage digital marketing, as I talked about. So, of course, social media is certainly an area that can be leveraged on. If you are into B2B sector, then refer to LinkedIn, because there you can get most of your buyers. You can connect with them. You can reach out to them. You can also have various level of engagements through various content assets. Um, uh, if you are into B2C, you may probably refer to Instagram or Facebook, and build your brand awareness through that channel. Besides that, your website also plays a very strong air cover for your sales team, for your people, while for any content or any specific information about the solution, about the case studies which you have delivered, about the the key queries which you can answer through website. So there's, and at the same time, if you have any self-service buying option, then the website can also offer you your buyers the same. So yeah, these are some of the strategies which SMEs can adopt during this session. Ritika, any more question?
Yeah, there is one more question. What are some common pitfalls or challenges that companies face when implementing this approach during a recession, and how can they be overcome?
All right, Vish,
Dennis, you like to add it?
yeah, Vish, let me take this one. So certainly cash flow and accounts receivable are going to be front and center even more so than they are normally. They really got to manage that tightly. Now, one way to go about that is to get into smaller engagements or break the larger engagements into smaller chunks. That both does two things. One, it gets you your money faster because you're getting it in pieces. And two, it obviously provides you the opportunity to isolate the value propositions that you're going to be delivering along the way, right? Nobody's still doing Big Bang Theory, right? It's all break them into chunks, get the customer happy with that chunk, get paid for it, and just keep moving, right? And keep that wheel running. Another I've already touched on again, get some expertise in. And I want to bring this to a head on this point. Everybody argues about how if you buy my stuff, you're going to avoid technology obsolescence.
Mhm.
And you have a lot of reasons why that's true. And these reasons are valid. God bless you. The same idea holds by bringing in experts for short term assignments. You are avoiding marketing and sales obsolescence by getting those best practices from across the globe and introducing them into the organization. One, if it doesn't work, you got somebody to blame. And if it does work, you're a genius for having brought the expertise into the company. So fractional hiring in to get contract experts in there, those would be some of the things that I would be looking at. And again, I think I coined a phrase here, sales and marketing obsolescence, right? So I actually like that.
Yeah.
All right, Vish.
All right. So we have come to the end of this session, and we thank everyone to be part of this. We have planned another session, and that's going to be more interesting. And in sync with what we discussed today, is going to be qualifying leads. Is it magic or is it science? So this event is already posted on LinkedIn, and I would request you to confirm your participation, block your calendar, so that we can connect, and we can share more insights with you. In case if you have any questions with us, for us, you can share with me or Dennis. Our email IDs are uh, Dennis at romansnumbers.com, and my email ID is Vishwendra at growthsutras.com. So it's a pleasure speaking to all of you. Dennis, it's again a wonderful event which we had, wonderful session which we had today. I believe is going to be a lot of value for the audience in terms of understanding how they can shape, sharpen, and shift their go-to-market approach for this session.
Thank you, Vish. I really enjoyed it. And thanks, Ritika, for all the support. And if it's not obvious to our audience, please take the opportunity. If you have people that you think we should be inviting to our next sessions, let us know. We'll be eager to add them to our list. Um, and you know a lot of people, and I'm sure you. I think our next series on qualifying leads, and I suspect, Vish, that's going to be more than one session. This one should be. I'm really looking forward to that. I'm really looking forward to working on it to make it as interesting, hopefully, as at least today's was. So, thanks, everyone.
Thank you. Thank you, Dennis. Thanks, Ritika. It's a pleasure to have you as part of the team. I think you have managed the logistics well for the event. So,
Thank,
yeah, we'll connect again. And thank you.
thank you, Dennis.